What if I told you that a law passed back in 1977 is one of the reasons your local bank might approve a mortgage for a small business owner in a neighborhood that big banks used to completely ignore? For decades, entire communities in America were basically invisible to banks. Not because people there didn't want loans, but because of where they lived. It even had a name: redlining. And one law was designed to fight back against it. Today, we're breaking down the Community Reinvestment Act, what it is, why it exists, and why it still matters to your money right now. Welcome back to Money Regulation Hub, the channel where we take confusing financial rules and turn them into something you can actually understand and use. I'm your host, and today we're tackling video number 10 in our regulation series. The Community Reinvestment Act, or the CRA for short. By the end of this video, you're going to understand what the CRA actually requires banks to do, why it was created, how it connects to the history of housing discrimination in America, and maybe most importantly, how this 45-plus-year-old law could actually affect your ability to get a loan, buy a home, or start a business today. Stick around because near the end, I'll also explain a major update to this law that happened just a few years ago, and it changes things for millions of Americans. Let's get into it. To understand the Community Reinvestment Act, you have to go back to a practice called redlining. Starting in the 1930s, government-backed mortgage programs and private banks began drawing maps of American cities. Neighborhoods were color-coded based on perceived risk, and areas with black and immigrant populations were almost always outlined in red, meaning banks considered them too risky to lend to, regardless of the actual financial situation of the people living there. Here's the plain English version. It didn't matter if you had a steady job and good credit. If you lived inside that red line, banks would often deny you a mortgage or a business loan simply because of your zip code. This wasn't a side effect, it was policy. And it went on for decades, cutting off entire generations of families from building wealth through home ownership, which, let's be honest, is still one of the biggest wealth building tools in America. By the 1970s, activists and lawmakers had documented what they called redlining and disinvestment. Banks taking deposits from a community, but refusing to lend back into that same community. Picture your neighbor depositing their paycheck into a local bank branch every month, while that same bank turns around and only approves loans in wealthier neighborhoods across town. That imbalance is exactly what Congress set out to fix. In 1977, Congress passed the Community Reinvestment Act. In simple terms, the law says this: banks have an ongoing obligation to help meet the credit needs of the entire communities they operate in, including low and moderate income neighborhoods, as long as it's done in a safe and sound way. Notice what the law does not do. It doesn't force banks to make risky loans. It doesn't set lending quotas. What it does is require regulators to evaluate how well a bank is actually serving all the neighborhoods where it takes deposits, not just the wealthy zip codes. Think of it like this. If a bank wants to open new branches, merge with another bank, or expand its operations, regulators are required to check its CRA record first. If a bank has a poor track record of lending fairly across its community, that can actually slow down or block approval for these business moves. So the CRA gives banks a very real financial incentive. Reinvest in your communities or face consequences when you want to grow. Here's where it gets interesting. Banks are periodically examined by regulators, usually the Federal Reserve, the FDIC, or the Office of the Comptroller of the Currency, and given a CRA rating. These ratings range from outstanding down to substantial non-compliance. Regulators look at things like, how many loans is the bank making in low and moderate income areas? Is the bank investing in community development projects like affordable housing or small business support? Are bank branches and ATMs actually accessible in these neighborhoods, or are they all clustered in wealthier areas? And here's the part most people don't know. These ratings are public. Anyone can look up a bank's CRA rating. So if you're choosing a bank and community reinvestment matters to you, you actually have the ability to check that record before you open an account. That's a level of transparency most people don't even realize exists. Let's make this concrete. Say you're a small business owner in a working class neighborhood and you need a $50,000 loan to expand your shop. Before the CRA, a bank in that area might not have had much incentive to work with you. Your neighborhood wasn't seen as worth the investment. Under CRA obligations, that same bank now has a regulatory reason to actively develop lending programs, sometimes with more flexible underwriting, specifically for businesses and home buyers in underserved areas. This has led to real programs over the years. First-time homebuyer assistance, down payment grants, small business lending initiatives, and financing for affordable housing developments. Community development financial institutions, sometimes called CDFIs, have also grown in part because of partnerships encouraged by CRA obligations, channeling capital capital into neighborhoods that were historically overlooked. Now, has the CRA fixed every inequality in American lending? No. And it's important to be honest about that. Wealth gaps tied to historical discrimination are deep, and one law from 1977 can't undo decades of policy. But independent research has shown that areas covered by CRA obligations do see measurably more lending activity than similar areas that aren't covered, so the law does move the needle. Now, here's something a lot of people miss. The CRA got a major update. For years, critics on multiple sides pointed out the same problem. The law was written in 1977, before online banking existed. Back then, community meant the physical area around a bank's brick-and-mortar branches. But today, plenty of people bank almost entirely online with institutions that have few or no physical branches near them at all. So in October 2023, federal regulators finalized a modernized CRA rule. This update expanded how banks are evaluated to account for digital and mobile banking, mortgage and small business lending outside of just branch locations, and updated size thresholds for how strictly banks are examined based on their assets. It's the most significant change to CRA enforcement in nearly 3 decades. That said, and this is important for accuracy, implementation of parts of this rule has faced legal challenges and delays. So if you're watching this and want the very latest status, it's worth checking current regulatory announcements, since rules like this can shift. But the direction is clear. Regulators are working to catch the CRA up to how Americans actually bank today. Let's bring this all together. The Community Reinvestment Act was created in 1977 to combat redlining and force banks to reinvest in the same communities where they take deposits, especially lower-income neighborhoods. It doesn't require risky lending, but it does require fair consideration and creates real consequences, like blocking mergers or expansions for banks with poor community lending records. Banks get public CRA ratings you can actually look up before choosing where to bank. And in 2023, the rule was modernized to reflect the reality of online and mobile banking. The bottom line, this one law connects directly to whether small businesses get funded, whether families can buy homes, and whether entire neighborhoods get access to capital instead of being left behind. And that wraps up our breakdown of the Community Reinvestment Act. If this helped you understand a piece of financial regulation that actually affects real people's lives, do me a favor and hit that like button. It genuinely helps this channel grow. If you haven't already, subscribe, because we're breaking down a new financial regulation every single week. Drop a comment and let me know, did you already know your bank's CRA rating was public information? I'd love to hear your thoughts. And if you know someone who's a small business owner or a first-time home buyer, share this video with them. This is exactly the kind of thing that could actually help them. Next time on Money Regulation Hub, we're diving into another law that shapes your everyday financial life. So make sure you're subscribed, and I'll see you in the next video.